Hi, I'm Dr. John Prudhont, a principal and M&A business broker with the Business Brokers LLC in Las Vegas, Nevada. For this video, we will be looking at the core principles and applications of corporate finance. A core principle of corporate finance is that the relationship between corporate finance, the lifeblood of every business, and corporate governance is symbiotic. The first concepts I would like to discuss are agency and conflicts of interest. What is agency? A corporation, also referred to as the principal, is considered a separate person. However, a corporation doesn't have a body, so management and employees perform the duties needed to accomplish the corporation's duties as agents of the firm. What is the agency theory of moral hazard? Agency provides the potential for self-serving actions that counter the interests of shareholders and other stakeholders and can reduce the firm value. Incentive pay structures can encourage unethical behavior from agents of the corporation, its managers, and employees. The Wells Fargo Bank fraudulent bank account scandal, which may have started as early as 2003 and became public in 2016, is an example of how the principal agency dilemma can result in conflicts of interest and moral hazards. Incentive-based compensation was provided to customer-facing employees and management to generate new savings, checking, and credit card accounts daily as agents of the corporation. This resulted in the self-serving, unethical opening of thousands of fraudulent accounts by Wells Fargo employees and over $200 million in fines, penalties, loss of employment for more than 5,000 workers, and forfeited compensation to managers and employees. The next core principles are the three standard financial statements for business: the statement of cash flows, income statement, and balance sheet. Important areas of the statement of cash flows are the net cash from operating activities, investing activities, and from financing activities. From the income statement side, we can find the total revenue and net income numbers. The balance sheet provides the value of the total assets of the firm. Netflix's financial statements reflected in the 10-K filed for 2016 can be used to tell management and investors more about the financial performance and health of the corporation. What do the numbers show? A net cash deficit of over $2.2 billion was reported for 2015 and 2016 combined. The statement of cash flows also reflects net cash flows from financing activity, selling shares of stock, and from lenders, which totaled $3.277 million and appear to have been used to offset losses and long-term asset acquisitions. From these two measures, Netflix is not producing sufficient revenue from its day-to-day activities to meet its expenses. From the balance sheet, the year-over-year growth of total assets increased in 2016 by over $3.3 million, and its long-term debt grew. The income statement reflects a yearly revenue increase of a little over $2 million in 2016, demonstrating significant growth and profitability recovery. Capital budgeting involves assigning assets to various business activities and deciding when and how to use in-house and outside financing. Determining the value of opportunity costs associated with whether to hold versus invest excess cash is subjective. The corporation might use internal funds and external funds and switch between the use of each as needed. An option might be for the corporation to use leverage, which is borrowing money and increasing debt, to allow a firm to take advantage of perceived opportunities in the marketplace. Borrowing increases risk due to an erratically unstable environment, such as recessionary and inflationary periods, and incomplete or asymmetric information. Excess cash from revenue-generating activities and leverage can be used for investment. Several methods exist for a corporation to estimate whether a given asset is a good bet. One method for calculating whether to invest excess cash is to determine if a project or financial instrument has a projected positive net present value, or NPV. The NPV calculation is used to estimate what future cash flows are worth today, and since cash is limited, to assist with choosing the best estimated return project or projects to invest in. Additional tools used include internal rate of return, or IRR, modified IRR, payback period, or PB, scenario analysis, and sensitivity analysis, with the weighted average cost of capital, or WACC, cost of debt, cost of equity methods used to calculate the cost of capital. Azure Logic Incorporated provides examples of how capital budgeting and cash flow management are used in practice. In this case, a decision must be made between two hotel locations that need renovation to increase performance. Due to the company's capital rationing, only 15 properties can be renovated this year. NPV needs to be calculated for each hotel to determine the NPV without renovation and the NPV with renovation, which will provide the highest increase in positive NPV to pick the order of hotel renovations. The NPV must include projections for revenue increase and utility and maintenance costs savings after renovation. Additionally, the projected sale value of the hotels at the end of year 5 for $1.1 to $1.3 million must be included in the NPV calculation.